Advanced Audit and Assurance, Chapter 10, Group Audits. Contents: 1. Introduction to Group Audits. 2. Group Audits Preliminaries. 3. Working with Component Auditors. 4. Auditing the consolidated process. 5. Documentation and communication with management and those charged with governance. 6. Chapter Review. Introduction. Competencies: planning and undertaking work, reliance on internal audits, specialists, and the work of other auditors, visits to locations, branches, and departments. Exam context. Group audits can be complex and confusing. Regulators often identify group audits in their quality inspections as an area that needs improving. With this in mind, a whole chapter is dedicated to group audit in compliance with the ISA 600. By the end of this chapter, students will be able to 1. Summarize the core components and considerations of group audit. 2. Describe how component auditors are used and the various communications that they will partake in. 3. Explain the responsibilities and tasks involved in performing a group audit in compliance with ISA 600, including planning, performing, and reporting. Subtopic 1. Introduction to Group Audits. Section Overview. 1. Introduction. 2. Group audit and the audit of individual group companies. 3. Possible problems with group audits. 4. Terminologies in group audit. Section 1.1. Introduction. A group audit is the audit of group financial statements. For this topic, you need to be aware of the requirements of the following accounting standards. 1. IFRS 3, Business Combinations. 2. IFRS 10, Consolidated Financial Statement. 3. IFRS 11, Joint Arrangement. 4. IFRS 12, Disclosure of Interest in Other Entities. 5. IAS 27, Revised, Separate Financial Statement. 6. IAS 28, Investment in Associates. In addition, IAS 24, Related Party Disclosure, is also of particular relevance because companies within a group are related parties. Section 1.2. Group Audit and the Audit of Individual Group Accounts. Much of the basic audit work for groups of companies consists of auditing the financial statements of the individual companies in the group. The parent company and subsidiaries are referred to for audit purposes as the components of the group. The audit work on the financial statements of the components of a group will follow normal auditing principles and practice. This chapter is concerned with the additional audit considerations that arise in connection with the preparation of group financial statements. Section 1.3. Possible problems with group audits. The organization and planning of a group audit is usually more complex than the planning of the audit of a single company for the following reasons. 1. Group may include a large number of companies. Some group companies may be foreign subsidiaries that report in their own currency and perhaps use their national accounting practices to prepare their financial statement rather than international financial reporting standards. 2. Some companies in the group may have a different year-end accounting date from other companies. 3. It will be necessary to make or audit adjustments that are made to financial statements of individual group companies for consolidation purposes. 4. Some group companies may be audited by an audit firm that is not the auditor of the parent company. Section 1.4 Terminology in Group Audits. Some special terms from ISA 600 see below are used for group audits. Definition: Group Engagement Team. The Group Engagement Team is the audit team responsible for the audit of the group financial statements and will usually also be the audit team responsible for the audit of the parent company. ISA 600 in fact refers to the group audit, the group engagement partner, and the group engagement team, whilst a number of other ISAs use the term group auditor as the synonyms for group engagement team. The group engagement team will establish the overall group audit strategy, communicate with component auditors, perform work on the consolidation process, and evaluate the conclusions drawn from the audit evidence obtained in order to form an opinion on the group financial statements. Each of the above stages is considered in more detail in the remainder of this chapter. Definition: Component auditor. A component auditor is an auditor who, at the request of the group auditor, performs work on the financial information of a component. For example, the audit of an individual subsidiary, associate, or joint venture may be performed by audit firm A when the group auditor is audit firm B. Audit firm A is a component auditor. Definition: Component. A component is an entity or business activity for which group or component management prepares financial information that should be included in the group financial statement. Subtopic 2: Group Audits Preliminaries. Section Overview. 1. Audit of Group Financial Statements, ISA 600. 2. The relationship between the group auditor and component auditors. 3. Accepting an appointment as group auditor. 4. Understanding the group, its components, and component auditors. 5. Materiality. 6. Planning and controlling a group audit. Section 2.1 Audit of Group Financial Statements, ISA 600. ISA 600 Special Considerations. Audit of Group Financial Statements, including the work of component auditors, was issued in October 2009 as a revised and redrafted ISA as part of the IAA SB's Clarity project, but also represented the result of a long consultation process on group audits. The revised ISA 600 contains much more extensive guidance than the original ISA 600. Section 2.2 The relationship between the group auditor and component auditor. ISA 600 regulates situations where group financial statements include financial information of components that are audited by other audit firms. The group auditor is required to determine how the work of the component auditor will affect the audit of the group financial statement. The group engagement partner is responsible for the direction, supervision, and performance of the group audit and issuing an appropriate group audit report. The group auditor is solely responsible for the audit report on the group financial statements, although ISA 600 does not in fact use this term. The group audit report does not therefore refer to any component auditors unless such a reference is required by local law. If it is required, the group audit report must indicate that such a reference does not reduce the group auditor's responsibility for the opinion on the group financial statement. Because of this sole responsibility, ISA 600 contains very specific guidance on the direction that the group auditor should give to the group audit and the group auditor's involvement in the work of component auditors. Section 2.3 Accepting an appointment as group auditor. It is normal practice for the auditor of the parent company to act as the group auditor. However, this is technically a separate appointment. As in the case of all appointments, the audit firm should consider whether it is in a position to accept the appointment as a group auditor. Before accepting appointment as group auditor, the audit firm should ensure that all the procedures relating to acceptance of an engagement per ISA 220 are met, and that they have a reasonable expectation of obtaining sufficient appropriate audit evidence about the consolidation process and the financial information components to reduce audit risk to an acceptable level. The firm does this by obtaining an understanding of the group and its components and their environments sufficient to determine which components are significant to the group, which significant components are audited by others, and whether as group auditor the firm will be able to be sufficiently involved in the audit of significant components to obtain sufficient appropriate evidence about them. If the group auditor is not able to be involved in the audit of a significant component, then it is unlikely that the group auditor can obtain sufficient appropriate evidence in respect of that component, and it should not accept or should resign from the engagement. If the auditor is prevented from resigning from the engagement by the law, he should issue a disclaimer of opinion on the group financial statement. Definition: significant components. Significant components are those that are of individual significance to the group, that is, individually material in a group context, or have been identified as likely to include significant risk of material misstatement of the group financial statement. Section 2.4. Understanding the group, its components, and the component auditors. In accordance with ISA 315, the group auditor must identify and assess the risk of material misstatement through obtaining an understanding of the entity and its environment. This will mean enhancing the understanding of the group, its components, and their environments, obtained at the acceptance or continuation stage, and obtaining an understanding of the consolidation process, including the instruction issued by management to its components. This will enable the group auditor to confirm or revise its initial assessment of components which are likely to be significant. When the group auditor plans to request a component auditor to perform work on the financial information of a component, he must assess the following issues. 1. Whether the component auditor understands and will comply with the ethical requirements that are relevant to the group audit, in particular that he is independent. 2. The component auditor's professional competence. 3. Whether the group engagement team will be able to be involved in the work of the component auditor to the extent necessary to obtain sufficient appropriate audit evidence. 4. Whether the component auditor operates in a regulatory environment that actively oversees auditors. The group auditor cannot simply rely on the work performed by the component auditor without assessing the likely quality of that work. If the component auditor is not independent, or there are serious concerns about any of the other matters above, the group auditor will need to obtain evidence relating to the financial information of the component without requesting the component auditor to perform any work. Section 2.5. Materiality. The group audit will need to set group materiality for the group financial statements as a whole and component materiality for those components where component auditors will perform an audit or a review for the purpose of the group audit. Component materiality will usually be lower than group materiality if a component has been audited in its own right because of local laws or regulations, and the group auditor decides to use that audit to provide audit evidence for the group audit. The materiality threshold used on that audit will need to be assessed. If the threshold was too high, then additional work may be needed. Section 2.6. Planning and controlling a group audit. The principles and guidelines for planning and controlling a group audit are similar to those for the audit of an individual company. However, additional considerations arise in regard to the complexities of a group audit. These additional considerations will require the group auditor to do the following. 1. Familiarize himself with the client's procedure for preparing group financial statements. For example, the client may use standard consolidation schedules. 2. Ascertain the client's timetable for the preparation of group financial statements. 3. Establish an audit strategy and audit plan for the entire group audit, including the audit on components. This should include staffing requirements for the group audit, a timetable for the audit of the company financial statements and the group financial statement, an action plan for possible problem areas, for example, foreign subsidiaries, arrangements for communication and cooperation with component auditors. Subtopic 3. Working with component auditors. Section overview. 1. Determine the type of work to be performed on components. 2. Communication with component auditors. 3. Involvement of the group auditor in work performed by component auditors. 4. Joint auditors. Section 3.1. Determining the type of work to be performed on components. Where a component is of individual financial significance to the group auditor or a component auditor must perform an audit using component materiality. Where a component is significant because of likely significant risk of material misstatement, the group auditor or a component auditor must perform one or more of the following. 1. An audit using component materiality. 2. An audit of one or more account balances, classes of transactions or disclosures, depending on where the risk of material misstatement lies. 3. Specified audit procedures to address the risk of material misstatement. For non-significant components, the group auditor should perform analytical procedures at a group level. If the group auditor does not consider that sufficient appropriate audit evidence will be obtained from the sum of the above work, then additional work should be performed on non-significant components, similar to that for significant components. The selection of such components should be varied from year to year. Section 3.2. Communication with component auditors. If there is not effective communication between the group auditor and the component auditor, there is a risk that the group auditor may not obtain sufficient appropriate audit evidence in which to base the group audit opinion. It is therefore vital that there is a clear and timely two-way communication between the group auditor and the component auditor. The group auditor's requirements are usually communicated in a letter of instruction. The component auditor's communication with the group auditor will usually be in the form of a memorandum or report of work performed. However, such communication may not necessarily be in writing. For example, The group engagement team may visit the component auditor to discuss identified significant risk or review the relevant parts of the component auditor's documentation. In such cases, matters must be properly documented in accordance with ISA 230. In cooperating with the group auditor, the component auditor will provide the group engagement team with access to relevant audit documentation, provided this is not prohibited by law or regulation. The group auditor's letter of instruction to the component auditor should set out the work required, the use to be made of that work, and the form and content of the component auditor's communication with the group engagement team. It should also include a request for cooperation, ethical requirements, component materiality, identified significant risk, a list of known related parties. The component auditor's report of work performed should include a statement of compliance with ethical and group auditor requirements, identification of the financial information on which the component auditor is reporting, any instances of non-compliance with law and or regulation which could lead to a material misstatement of the group financial statement, a list of uncorrected misstatements of the financial information of the component, indicators of possible management bias, any identified material weaknesses in internal control, any other significant matters the component auditor expects to communicate to those charged with governance of the component, any other matters that may be relevant to the group audit, the component auditor's overall findings, conclusions or opinion. Section 3.3. Involvement of the group auditor in the work performed by component auditors. It is the group auditor's responsibility to decide what work is to be performed on the financial information of the component by the component auditor. The group auditor then has to decide the extent of his involvement in that work. For significant components, he must, as a minimum, discuss with component management or the component auditor the business activities of the components that are significant to the group, discuss with the component auditor the risk of material misstatement of the financial information of the component, and review the component auditor's documentation of identified significant risk of material misstatement of the group financial statements. Where significant risk of material misstatement of the group financial statement have been identified at a component, the group auditor should 1. Evaluate the further audit procedures to be performed to address such risk, and 2. Consider whether it is necessary to be involved in those procedures. Such involvement might include 1. Meeting with component management or auditors to obtain an understanding of the components. 2. Reviewing the component auditor's overall audit strategy and plan. 3. Performing risk assessment procedures at the components. 4. Designing and or performing further audit procedures. 5. Participating in closing or other key meeting between component auditors or management. 6. Reviewing other relevant parts of the component auditor's documentation. For other components, the extent of the group auditor's involvement will depend on his understanding of that component auditor. If he has concerns about that particular component auditor's competence or a lack of local regulation, he may decide that he needs to be involved in that component auditor's risk assessment. In all cases, the group auditor is required to evaluate the report of the work performed by the other auditors. If after such evaluation and after discussion with component auditor or management, the group auditor concludes that the work is insufficient, it should 1. Determine what additional procedures are needed, and 2. Whether such procedures should be performed by the component auditor or himself. Section 3.4 Joint Auditors. A joint audit involves 2 or more audit firms being appointed to audit the financial statements of an entity. Joint audits may occur in other situations, but they are most commonly found in group audits. In particular, when a group acquires a new subsidiary, it is not unusual to appoint the group's auditors jointly with the subsidiary's existing auditor, at least for a period of time after the acquisition. The joint audit provides a joint opinion on the financial statements of the subsidiary. Advantages of joint audit. The reason why joint auditors might be appointed include the following issues. 1. The client's company may be so large that it requires the service of more than one firm of auditors. 2. After the acquisition of a large subsidiary, using joint auditors may help the transition process while the group auditors become familiar with the new subsidiary. The old auditors should be familiar with the business of the subsidiary and should pass their knowledge over to the parent company auditor. For the parent company auditor, this should accelerate the process of getting to know the business of the new subsidiary. 3. Joint auditors may provide a higher level of technical expertise than either audit firm could provide individually. 4. Improved geographical coverage may be obtained for the audit, where each of the joint auditors on its own does not have offices that cover all the geographical locations of the component companies in the group. 5. It has been suggested that 2 medium-sized accountancy firms might join forces and tender for the audit of a company for which the auditors would normally be one of the Big 4 accountancy firms. This is possibly a way in which medium-sized firms might try to break the monopoly of the Big 4 on large company audits. Disadvantages of joint audit. Possible disadvantages of joint audits include the following. 1. The extra cost to the client. It is likely to cost more to use 2 accountancy firms than to use 1. 2. Possible inconsistencies between the 2 joint auditors in the audit methods that they use. If so, there may be problem in reaching agreement on whose audit method to use. 3. The possible difficulty the 2 firms may have in agreeing the division of work. 4. Additional problems that will arise in monitoring and controlling the audit work of 2 different firms. 5. The 2 firms may find it difficult to work well together, and each firm may try to become the leading firm in the joint audit. 6. If there is a claim against the auditors for negligence in the conduct of the audit, there may be some difficulty in identifying which of the joint auditors is potentially liable. The key to a successful joint audit is good communication between the 2 firms, including joint planning meetings and regular discussions between the firms at all key stages of the audit process. The meeting and discussions should be fully documented. Subtopic 4. Auditing the consolidation process. Section overview. Role of the group auditor with regard to consolidation. The main audit procedure relating to consolidation. Subsequent events. Section 4.1. Role of the group auditor with regards to consolidation. As discussed above, ISA 600 requires the group auditor to obtain an understanding of the consolidation process, including the introduction, issued by management, including the instructions issued by management to the components. This will allow assessment of the risk involved in the consolidation process. The group auditor will want to confirm that the following actions have been taken correctly by the client company. 1. There has been a full and accurate transfer of information from the individual financial statements of the components of the group to the final consolidated financial statements. 2. Appropriate consolidation adjustments have been made. However, the amount and type of detailed audit procedures to be carried out will depend on the group auditor's assessment of risk in this area. Section 4.2. The main audit procedures relating to consolidation. The table below sets out the main audit procedures that could be performed in relation to the consolidation process, that is, preparing the consolidated financial statement from the financial statements of the individual components in the group. Topic and the audit procedures. Clerical accuracy. Confirm that figures have been transferred accurately from the financial statements of the components to the consolidation schedule. Check the arithmetical accuracy of all consolidation calculations, such as the consolidation total balances and total transactions value. Status of investment. Confirm that the parent company has correctly classified investments as a subsidiary, associate, joint venture, or simple investment in accordance with standard accounting practice. Confirm that the appropriate accounting treatment has been adopted for each of these classification of investments in the group account. Changes in the group. For acquisitions, confirm fair values, the calculation of purchased goodwill, and accounting treatment in accordance with IFRS 3 and any other relevant standards. Where there has been an acquisition during the year involving deferred consideration as part payment, check that the amount of the deferred consideration has been included in the cost of the acquisition at discounted present value, using a current pre-tax cost of capital as the discount rate. Note: the cost of the acquisition affects the amount of the purchased goodwill. Where there has been an acquisition during the year involving a possible contingent consideration as part payment, check the reasonableness of the assumptions that the recent value of the contingent consideration should be included in the cost of the acquisition. For disposals, confirm the sales proceeds and the calculation of the gain or loss in sale. Check that the correct accounting treatment of items are applied in the consolidated income statement or statement of comprehensive income and the consolidated. For example, when a subsidiary has been acquired during the year, check that the calculation of pre-acquisition and post-acquisition profit is correct. Consolidation adjustments. Reconcile the intercompany transactions and balances, or review the reconciliation of the intercompany transactions and balances that has been made by the client staff. Confirm the intercompany balances. Check calculations of the adjustments for unrealized profit. Check the calculations and disclosure of non-controlling interest. Check the accounting treatment of intercompany dividends and other dividends. Loss-making investments. Consider whether any goodwill on acquisition has suffered an impairment. Consider whether a write-down of the investment in the book of the parent company is needed. If a subsidiary makes loss consistently, its going concern status may be in question. However, the group may take a formal decision to provide financial support to the subsidiary. This decision, in effect, would protect the going concern status of the subsidiary. If it is making losses, in such a situation, the group auditor will normally request a comfort letter or support letter to this effect from the director of the parent company. Related parties. Ensure the provision of IAS 24 are complied with. Most components of the group will be related to most other components. Reporting. Reach a conclusion about whether the group financial statements present a true and fair view. The principles relating to group audit reports are dealt with in a later chapter. Notes. Consolidation adjustments are adjustments that are made after the financial statements of the individual group companies have been prepared. The adjustments are needed to consolidate the financial statements of the individual companies into a single set of group financial statements. Consolidation adjustments may therefore include adjustments to the financial statements of individual group companies to achieve consistency of accounting policies. There are also adjustments for intergroup balances and closing inventory from intra-group sales for goodwill impairment and so on. Section 4.3 Subsequent events. The subsequent event review will need to include procedures to identify events at components that occur between the date of the component's financial information and the date of the group audit report. These procedures could be carried out by the group auditor or by the component auditor. Subtopic 5. Documentation and communication with management and those charged with governance. Section Overview. 1. Documentation. 2. Communication with group management. 3. Communication with those charged with governance of the group. Section 5.1 Documentation. In addition to meeting the requirements of ISA 230 audit documentation, the group auditor must also document the following matters. 1. An analysis of components, identifying significant components. 2. The type of work performed on the financial information of components. 3. The extent of the group auditor's involvement in the work performed by component auditors on significant components. 4. Written communication between the group auditor and the component auditor concerning the group auditor's requirements. Section 5.2 Communication with group management. The group auditor should make group management aware on a timely basis of the following matters. 1. Material weaknesses in the design or operating efficiency of group-wide controls. 2. Material weaknesses which are significant to the group that the group auditor has identified as components. 3. Material weaknesses which are significant to the group that group auditors have identified as components and have brought to the attention of the group auditor. 4. Any fraud or suspected fraud identified by the group or component auditors. The distinction between management and those charged with governance, see below, who could in fact be the same, is covered in a later chapter. Section 5.3 Communication with those charged with governance of the group. In addition to the matters required to be communicated within ISA 260, communication with those charged with governance, ISA 600 requires the group auditor to communicate the following matters to those charged with the governance of the group. 1. The type of work to be performed on the financial information of components. 2. The group auditor's planned involvement in the work to be performed by the component auditors. 3. Any concerns over the quality of any component auditor's work. 4. Any limitation on the group audit, e.g., lack of access to information. 5. Any fraud or suspected fraud involving group management, component management, or employees with significant role in group-wide controls where the fraud resulted in a material misstatement of the group financial statement. Subtopic 6. Chapter Review. Chapter Review. Before moving on to the next chapter, check that you now know how to 1. Summarize the core competencies and consideration of group audit. 2. Describe how component auditors are used and the various communications that they will partake in. 3. Explain the responsibilities and tasks involved in performing a group audit in compliance with ISA 600, including planning, performing, and reporting. Quick quiz questions. Question 1. What is the preferred treatment of goodwill arising on consolidation under IFRS? A. Write-off against reserves. B. Capitalize and test for impairment when impairment indications arises. C. Carry on the balance sheet indefinitely. D. Capitalize and test for impairment annually. Answer is D. Under IFRS 3, goodwill arising on consolidation, that is purchased goodwill, should be capitalized in the consolidated statement of financial position and tested annually for impairments. Question 2. Which of the following statements is correct? A. Responsibility for a group audit is shared by the group auditor and any component auditors. B. An audit firm may accept an engagement as group auditor even if it is insufficiently involved in the audit of significant components to obtain audit evidence about them. C. A group auditor may rely on the work done by a component auditor without the need to assess its quality. D. The group auditor sets the group materiality level for the financial statements as a whole and component materiality level for components audited by component auditors. Answer is D. The group auditor has the full responsibility for the group audit. It must therefore assess the quality of the work of any component auditors. Question 3. Which of the following statements about the group engagement partner in a group audit is incorrect? A. The group engagement auditor is responsible for the opinion on the group financial statement as a whole. B. The group engagement auditor can demand information and explanations from the component auditor. The group engagement auditor needs to consider the materiality of the portion of the group audited by him. D. The group engagement auditor can demand coterminous year ends for all group companies. Answer is D. It is up to the parent company to decide on the year ends of group companies. Some subsidiaries may operate in countries that specify by law the year ends that must be used, so it is not always possible for all group companies to use the same year ends. Question 4. Which of the following statements is correct? A. A component auditor should provide the group auditor with access to its relevant auditing documentation. B. A component auditor should provide the group auditor with a report of work performed unless the group auditor specifically states that it is not necessary. C. When there is a joint audit, one of the firms must act as the senior firm in the audit. D. When a component within a group is significant, the audit of the component should of the components should use group materiality? Answer is A. A component auditor should always provide the group auditor with a report of work performed. When a component within a group is significant, the audit of the component should use the component materiality. Question 5. In a group audit, which of the following should be included in the main audit procedure in relation to the consolidation process? 1. Clerical accuracy. 2. Consolidation adjustments. 3. Status of investment. Options 1 and 2 only for A. B. 1 and 3 only. C. 2 and 3 only. D. 1, 2 and 3. Answer is D. There should be a check that the client has made the consolidation calculation accurately and that all the consolidation adjustments have been made for intercompany balances, unrealized profits in closing inventory, etc. The status of investment should also be checked to verify that entities within the group are correctly classified as subsidiaries or associates. That is the end of chapter 10. Thank you.